Greetings, viewers. I welcome you all to the series on security analysis and investment management. I am Dr. Isha Raval, Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. In today's lecture, we are going to discuss about the various approaches to investment decision making. That what are the different methods which one can apply while deciding where to invest the funds. The stock market, the security market per se, is thronged by investors pursuing diverse investment strategies, which can be subsumed under four broad approaches. The four broad approaches which I just mentioned are fundamental approach, psychological approach, academic approach, and then eclectic approach. As you can see on the screen, that all the four approaches are of equal importance, and different types of investors, they prefer different type of approach while deciding where to put their funds while selecting the securities. To begin with, fundamental approach. This is one approach which actually determines what ought to be the price. What is the intrinsic value of a particular share? Suppose there is a company by the name of ABC Limited, and the stock price of that particular company in the market is, say for example, 1,120 rupees. Now a person, an individual who is trying to use the fundamental approach while analyzing whether the price of 1,120 is correct or not, will actually go through the balance sheet, will understand the entire organization, and then decide whether this is the appropriate price, whether 1,120 is the intrinsic value of this particular stock or not. And then he or she may decide whether to buy or not to buy the security. So the basic tenets of the fundamental approach, which is perhaps most commonly advocated by investment professionals, are: the first one, there is an intrinsic value of a security, and this intrinsic value depends upon the underlying economic fundamental factors. The intrinsic value can be established by a penetrating analysis of the fundamental factors relating to the company, the industry, and then the economy. We actually have two different approaches under it. One is the top-down approach, and the second is your bottom-up approach. In the top-down approach, you first understand and analyze the economy. After analysis of the economy, you go down to the industry, and after understanding the industry, you go down to the selection of the company. For example, if given a choice between, say, India or China during the year 2020, if somebody has to do any sort of investment and you give an alternative to that person, that which country will they choose to select or invest their funds in, they will certainly say that because there is complete lockdown, there are a lot of issues with Chinese economy, we will prefer investing in the Indian economy. Because they understand that if the economic condition of a particular country is not favorable, it is very difficult for an industry or a specific company to grow within that economy. So given this understanding, when you look at the GDP rate, when you understand the economic conditions of a country, you decide that no, country A is better than country B is a part of the fundamental analysis. So after economic analysis, the second analysis which is done as a part of fundamental approach is understanding the industry. So within the Indian economy, if you are given a choice whether you would want to invest in the FMCG sector or whether you will put your funds in the steel sector, say these are the two industries which we are comparing. Going back to the year 2020, when we understood that the basic necessity, the consumption of the basic goods will still continue vis-a-vis an industry like steel. For that matter, if you compare the pharma sector, that was one sector which was actually booming like anything during those time. When the entire economy was in doldrum, the entire economy was not in a good position, the pharma companies were still doing good. So you as an investor understand that, okay, this is one country where I can park my funds. Which is the most developing sector, the best sector, which is generating good amount of return. You select that particular sector. After that, you do the industry analysis, and after your industry analysis, now which company to put my funds in. So within the pharma sector, is it company A or company B or company C? And you understand, you study the balance sheets of all the three companies, you check their returns, you check their market price to earning ratio. When you do such sort of calculation, here you are actually understanding that specific company, and you select the best performing company. You start with the economy, then go down to the industry, and then to the company, which is known as EIC analysis under fundamental approach. The second alternative is that if you are fond of a particular company, if you know that there is one company which really fascinates you, and you really know, or you may be knowing the management of the company, or you are well versed with the working of that specific company, you start with the company first, then you see whether this company is headquartered in which country, and you see which sector this company is into. After identification and analysis of the sector or the industry, you move up the ladder and you study how is the economy of that entire country doing, where your specific favorite company is located. That sort of analysis is known as CIE analysis, which is bottom up approach. You're going from the bottom to the top under CIE analysis, and under EIC analysis, that is a top down approach which studies the economy, the industry, and the company. So this sort of analysis is a part of your fundamental analysis. So at any given point of time, there are some securities for which the prevailing market price would be different from the intrinsic value. Sooner or later, of course, the market price would fall in line with the intrinsic value, and that is one assumption which is made under the fundamental approach. And you are trying to make a decision using this fundamental approach to identify those particular securities which are undervalued, which are not appropriately priced right now, and their value, their market price is much lesser than their intrinsic value. So you look for such securities where the intrinsic value is much higher vis-a-vis the market price, and you try to buy these undervalued securities, because if you are going to buy such securities in the long run, certainly the market price will touch the intrinsic value and you are going to make profit. Or the other alternative is you can sell the overvalued securities. What is overvalued? Overvalued securities are those securities whose intrinsic value is less than the market price. So this sort of analysis, the fundamental approach of analyzing securities, it assists in identification of underpriced securities to be bought and overpriced securities to be sold. So there are two approaches under fundamental approach. The first one, which we discussed, is top down, EIC, and the bottom up is CIE, company, industry, and then economy analysis. There are very famous investors. The most famous one in the world, which everybody knows, is Warren Buffett. He is one such investor who follows the fundamental approach while selecting the securities to invest, because Warren Buffett always says that I invest in those securities, I invest in those companies which I understand the business model, the working of those companies which he understands. He prefers putting his money in those companies, and that is why he is known as the fundamental investors, one of the largest investors, the chairman of Berkshire Hathaway, and he has actually built an empire just by investing in the stock markets and by doing the fundamental analysis or following the fundamental approach of analysis. We even heard late Shri Rakesh Jhunjhunwala ji. He is an Indian investor. He was an Indian investor who has again built an entire empire, and he also strongly believed in the fundamental approach of doing the analysis of security selection. The second approach which we discussed was psychological approach. As the word itself says, a psychological approach. That means an approach which is followed, which is based on the premise that stock prices are guided by emotions rather than reasons. That means you are driven by the psyche of the market. You are not driven by the reason, the fundamental reason of the up and the down of the security market prices. Stock prices are believed to be influenced by the psychological mood of the investors, of extreme optimism and extreme pessimism. That means if everybody in the market is buying and there is an entire euphoria that the prices will rise and they will continue to rise, there is a lot of greed in the market and you know that the market will continue to rise, everybody is optimistic, there will be no downfall, then in that case you are following the psychological approach and you land up buying a stock which is really trading at a very, very high price with a very high PE ratio, the market price to earning ratio. Then in that case, when you are driven by such greed, when you're driven by such euphoria, which is sweeping the market, the prices, they rise to dizzy heights, which actually leads to irrational exuberance, which actually leads to you landing up buying a commodity or a stock which is not actually worth it. On the other hand, when a lot of fear and there is a lot of despair which is enveloping the market, the prices fall to abysmally low levels. Now, since the psychic values appear to be more important than the intrinsic values under this approach, the psychological approach suggests that it is more profitable to analyze how investors tend to behave as the market is swept by waves of optimism and pessimism. It involves a study of market generated data like prices and the volumes to determine the future direction of price movement. So it is neither logical nor understandable that how can one decide just that why to put your funds, because everybody is rushing after a particular stock, you also land up investing in the same. That is the psyche, that is the kind of market which is driven by greed and fear. And there's a very famous saying, a lot of investors say that when people have to be greedy, they tend to become fearful. And people actually become fearful when they should actually be greedy, because they do not understand the balance between greed and fear, and these are two very important emotions which actually drive the stock market. The basic premise of psychological approach is that there are certain persistent and recurring patterns of price movements which can be discerned by analyzing market data. So, psychological approach is actually related to the technical analysis, which uses a variety of tools like bar chart, point and figure chart, moving average analysis, breadth of market analysis, and many more. This approach actually says that the entire stock market is 90% psychological and just 10% logical. So, more of emotion than reason. That is why when such things happen, when there is a recession, when market crashes, it is always landing up into either the overbought or oversold zones. So this is one approach which says that the emotions drive the market and one should actually make a decision whether to invest in a stock or not just by looking at the previous price, the previous change, and how that particular stock is behaving in the past, because it says that the history repeats itself. That is about psychological approach. The third approach is academic approach. Over the last 5 decades or so, the academic community has studied various aspects of the capital market, particularly in the advanced countries with the help of highly sophisticated methods of investigation. While there are many unresolved issues and controversies which are stemming from such studies pointing into different directions, there appears to be substantial support for the following tenets. Stock markets are reasonably efficient. We say that stock markets, the market is always right, the investors are intelligent. And the basic premise under academic approach is that stock markets, they are reasonably efficient in reaching quickly or in reacting quickly as well as rationally to the flow of information. So the academic approach of analysis of the stock market says that stock markets or the stock prices, they reflect intrinsic value fairly well. That means that over the period of time, with time, ultimately the stock prices will come back to their intrinsic value, and there will not be any sort of undervalued security or overvalued security. There will not be a situation called underbought or oversold market. So this approach is one such approach which actually emphasizes that stock markets are efficient. There's a very famous hypothesis, efficient market hypothesis, which is the fundamental tenet of academic approach, wherein it is believed that stock prices, the price of a particular stock, will actually come back to its intrinsic value. So stock market behavior, it corresponds to a random walk. So when we say random walk, somebody who is walking randomly, it is very difficult to predict whether he'll go left or right. People taking a stroll. So in that case, you cannot say what will be the next step. This means that whenever there is a change in the price of a particular stock, the successive price changes, they are completely independent. As a result, the past price behavior cannot be used to predict the future price behavior. This is a very important observation, that when you really cannot say what is going to be the next change in the price, you are actually saying that there is strong positive relationship between the risk and the return. So ultimately, the return which you are going to get from a particular stock will be in tandem with the kind of risk, the quantum of risk which you are bearing, because the reason is that stock markets are efficient. They know that ultimately they have to reach to a situation where the price of every security is equal to its intrinsic value, the true value, the actual worth of that security, which is again dependent on the fundamental analysis. The next approach is, in fact, the last approach here is the eclectic approach. The eclectic approach draws on all the three different approaches discussed above. The basic premises, the assumptions of this approach are: fundamental analysis is helpful in establishing basic standards and benchmarks. Therefore, when we have these uncertainties associated with fundamental analysis, exclusive relevance on fundamental analysis should be avoided. Equally important, excessive refinement and complexity in fundamental analysis must be viewed with caution, because I may have a different perspective in calculation of the value anchor under the fundamental approach, and the other person may have a different perspective altogether. There is going to be a huge variation in the calculation which I made for a particular stock vis-a-vis done by the other person. That is why eclectic approach says that we need to take into consideration all the three approaches while we are deciding to buy a particular stock. The first reason it says is that because fundamental analysis, it is helpful in identifying, we come very close to the intrinsic value, we can actually understand the estimate, the value of a particular stock, but it is pretty complex in nature. Whereas the second approach which we studied was technical analysis or psychological approach. Now this analysis is very useful in broadly gauging the entire prevailing mood of the investors and the relative strength of supply and demand forces. However, even this particular approach is not very reliable. Why? Because this mood of the investors can vary unpredictably. Excessive reliance on technical indicators, which can be really hazardous. It can be very dangerous. In fact, the complicated technical systems should ordinarily be regarded as a suspect, because they often represent figments of imagination rather than the basic tools of proven usefulness. They are not so reliable. We are just guided by the emotions. We are just guided by the hype which is created in the market. We are just guided by the greed of the people and the fear which they are experiencing, which is actually landing us in irrational exuberance. That is why not sole dependency on technical analysis should be encouraged. So the third, market is neither as well ordered as the academic approach suggests, nor it is as speculative the psychological approach indicates. So while it is characterized by some inefficiencies and imperfections, it seems to react reasonably efficiently and rationally to the flow of information. So what are we trying to say is that the fundamental analysis emphasizes on the true value, the intrinsic value. The technical analysis or psychological approach emphasizes on the past market price, the behavior of the market, the emotions in the market, but we need to have a balanced approach. There has to be a balance. Therefore, the operational implications of the eclectic approach can be concluded that we must do the fundamental analysis to establish certain value anchors so that we get an estimate that okay, this is the price, the ideal price of a particular stock, and the range can be from say 100 to 120 or 130. So anything between 100 to 130, you're setting a value anchor, a representative which can tell you whether it is the appropriate price or not. So when you are selecting a particular stock, you must do the fundamental analysis, but it should not be too rigid that you arrive at a one particular value stating that 121 is the ideal price for a particular stock. No, we do not know what goes into the calculations. That is why the calculation of fundamental analysis can be done to assist to get a value anchor. But we need to also assist our analysis with the technical analysis to assess the state of the market psychology. So even if there is a very good stock and you know that it is likely to generate returns in the long run, but if the market is downbeat, if there are a lot of bears in the market and nobody is ready to buy your particular stock, and you know that the market is going to go into recession, the economy is going to recession, there is no point investing at that time. Therefore, the fundamental analysis must be supported with the technical analysis. So combining fundamental and technical analysis to determine which securities are worth buying, worth holding and worth selling is what is emphasized under the eclectic approach. We must respect the market prices and we must not show excessive zeal in beating the street or beating the market. Why? Because the market is intelligent, the market is efficient, and the market knows how to correct and when to correct. So if it is entering into the overbought zone where everybody is buying and the prices are rising to skyrocketing prices, the market will do the correction. Similarly, when the market is falling continuously and the market itself understands that now it is entering into the oversold zone where everybody is selling, the market corrects again. Therefore, we must accept the fact that the search for a higher level of return often necessitates the assumption of a higher level of risk. Both they move in tandem with each other. Higher the risk, higher the return. Again, lower the risk, lower the return. Now, when we have just concluded the four approaches of doing the analysis, the next topic for discussion is what are the qualities of a successful investor, or we can say what is there in successful in investing. The first is contrary thinking. You need to think against the herd. You should avoid herd mentality. Herd is when you see everybody together and moving in the same direction. But one who wants to make real money in the market is one who actually does contrary thinking, who has a contrarian approach, who goes against what others are thinking, and they are the people who actually make money. The second is patience. Obviously, when you are patient enough to analyze, you understand and you stay calm and you stay composed and you maintain the balance between the greed and fear, the two emotions which are driving your decision to invest or not. When you develop that patience, when you have that composure, you are likely to get more benefit and you're likely to get better returns. Then flexibility and openness. How flexible you are in terms of your decision making. One should not be too rigid about a company. One should not be too rigid about a particular approach. That doesn't mean that somebody who is follows a fundamental style of investing will not follow the technical analysis. We have to have an eclectic approach. We need to be open to suggestions. We need to keep our ears open so that even when people are talking about the news which is going to come into the market, what are the repercussions of that news, and you are flexible and you are ready to accept, you are likely to make good returns. Then is decisiveness. Now, One thing in the morning, people who invest or who trade in the stock market, they get phone calls in the morning itself from their brokers. Invest in so and so particular stock. No, that's not the right way of investing. When you are just investing on hearsay, when you're just investing on the cues you're getting from your brokers, that is one thing which should be avoided. You yourself need to decide. You should have that decisiveness and a firm decision making ability, and must go with your conviction, with your analysis when you are planning to make good returns in the stock market. So these are all the qualities of successful investing. And now we are going to talk about the common mistakes which an investor makes while investing. The first one is inadequate comprehension of return and risk. We do not do the actual valuation, how much return and how much risk. So that comprehension should be done properly. We should not actually vaguely formulate the investment policy. We should be clear whether we are a conservative investor or we are an aggressive investor. So that doesn't mean that if the bull run is going on, you also start buying. When the bear run is there taking place, you would actually, the aggressive investors, they turn unduly cautious and they overlook the opportunities before them. We should avoid having naive extrapolation of the past. History may not repeat itself and you have a lot of challenges. The cursory decision making should be avoided, and you should not simultaneously switch between one stock to the other just because somebody has recommended. Be decisive. Do not over diversify or under diversify. Have a lot of eggs in your basket, but that doesn't mean that you're going to put all of them in just one basket. Ensure that you have different baskets, different industries, different companies when you're creating your portfolio, and avoid buying shares of familiar companies. Just because you are familiar with a particular company, you know the management of that company, or you know that this company has been doing good in the past, do not put your funds there. And lastly, try to avoid the tendency to speculate. Do not speculate, because people have actually gone bankrupt when they have done wrong speculation. With this, we end this session. Thank you so much. Wishing you happy learning. Thank you once again.